Have you ever wondered how a small company suddenly becomes a global giant? How they build these massive factories or launch products that completely change the game? Well, it's not magic, it's fuel. And one of the most powerful fuels out there is something called debt financing. So let's break down exactly how it works. Right, so this is the million-dollar question, isn't it? For any company with big ambitions, this is everything. Look, growth costs a ton of money. Doesn't matter if you're a tiny startup or a huge corporation. The answer is always found in a really careful financial strategy. And trust me, debt is a massive piece of that puzzle. Okay, first things first. Before we dive into all the different kinds of loans and bonds and all the jargon, we really need to get the core idea down. What exactly is debt financing? And why on earth do companies even use it? Let's get this foundation right before we start building on top of it. The best way to think about a debt financing model is to picture a roadmap for a big trip. It's not just about holding your hand out and asking for cash. Nope. It's about showing lenders the entire journey. This plan proves that a company is strong enough to not only take on the debt, but to pay it back and keep on growing. It's this constant, delicate balancing act. On one hand, you desperately need that big injection of cash for a new project, maybe buying new equipment or even another company. But on the other hand, you absolutely cannot risk the day-to-day stability of the business. It's all about fueling that ambition without blowing up the engine. All right, so a company decides it needs to borrow. What are its options? Well, it's definitely not a one-size-fits-all kind of deal. A better way to think about it is like a financial toolbox, with different tools designed for very, very different jobs. Let's peek inside and see a few of the most common ones. Let's start with the three heavy hitters. First, you've got your term loans. These are for a big, specific, one-time purchase, like a major piece of machinery. Then you have revolving credit lines, which are all about flexibility for day-to-day cash needs. And bonds? Whoa, that's how companies raise huge amounts of money for massive projects, basically by borrowing straight from investors. Each tool has its own very specific purpose. Here's an even simpler way to picture it. A term loan is basically like a mortgage for a house. You get one big lump sum for one big specific thing. A revolving line of credit, on the other hand, is much more like a corporate credit card. You can borrow from it, pay it back, and borrow again, all for your short-term needs. So, choosing the right tool from the toolbox. It isn't a gut feeling. Not at all. It's based on this deeply analytical process called financial modeling. This is where companies essentially try to predict the future. They use all this data to see how taking on new debt is going to impact them down the road. And this quote here, it just gets right to the heart of it. The most important thing to remember is that these models replace guesswork with hard data. They let a company really dig into their cash flows, spot potential risks, and make decisions from a place of strength and knowledge, not just hope. So, what's the real payoff for doing all this work? Well, first off, a good model just leads to smarter decisions. It forces you to look at risks head on and ask those tough questions, like what happens if interest rates spike? It also lets you analyze all those different what-if scenarios. And maybe most importantly, a solid, transparent model builds the confidence you need to get lenders and investors on your side. Okay, so you've got this amazing, super detailed model, but how do lenders and investors make sense of it all? Fast. They look at these key metrics called financial ratios. Just think of them as the vital signs that tell the story of a company's financial health in a quick, easy-to-read way. Seriously, it's just like a doctor checking a patient's blood pressure and heart rate. Lenders use these financial ratios to see at a glance if a company is strong and healthy enough to handle the stress of taking on new debt. A quick look at these numbers can tell you a whole lot. All right, first up is the debt-to-equity ratio. And this one, it's a big one. It directly compares how much money a company has borrowed to how much its owners have actually invested. It's basically asking, is this place funded by debt or is it funded by its owners? And that tells you a ton about its reliance on borrowing and its overall financial risk. So what do these numbers tell us? Well, a high ratio means the company is using a lot of debt, what we call leverage, to grow. And that can supercharge profits, but boy, does it also crank up the risk. A low ratio signals a much more conservative, stable approach. And here's the thing, there's no single right answer. A crazy tech startup might want a high ratio for hypergrowth, while a steady utility company would want a much, much lower one. Next up is the interest coverage ratio. This one is super practical. It answers a really simple question. Is the company making enough money from its actual day-to-day business to easily cover the interest payments on its debt? It's a direct look at whether they can handle the ongoing cost of what they've borrowed. And finally, let's talk about the debt service coverage ratio, or DSCR. Now, the last ratio only looked at interest. This one is way more comprehensive. It asks, does the company's income cover all its debt payments? We're talking both the interest and the original principal. And this all comes down to one critical number, 1. If the DSCR is greater than 1, you're good. The company has enough cash to pay its bills. But if it drops below 1, oof, that is a major red flag that signals serious financial trouble. Okay, so we've covered models, we've covered options, and we've covered a bunch of ratios. But why should any of this matter to you if you're not a CFO? Well, because understanding how companies pay for things gives you this incredibly powerful lens to see the entire business world through. I mean, think about it. If you're an investor, this helps you gauge the risk of a stock you're thinking about buying. If you're an employee, understanding this gives you real insight into your own company's stability and its plans for the future. And of course, if you're a business owner, these are the absolute essential tools for responsible growth. This knowledge is empowering, no matter what you do. So the next time you look at a company's financial report, don't just see the numbers on a page. See the roadmap, see the toolbox, see the vital signs. Because every single number tells a story about ambition, about risk, and about the calculated bets that companies are making to build the future. And now, you know how to read that story.